What's up, everyone? It's Caddy with Money Investing. So UBS is taking over Credit Suisse for about 3.2 billion US dollars. And in this video, I wanted to talk a little bit about what that deal is going to look like and also go over the Swiss finance minister and what she said about this takeover. So I'm going to play a clip, which I think is very interesting. And then finally breaking down a research paper that was published on the U.S. monetary policy and the tightening with respect to how fragile the U.S. banking system is in 2023, and also talk about the mark-to-market losses for a lot of these banks that currently have at the moment, but their book values suggest otherwise. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below. Of course, if you're interested in joining us and get access to all the buy and sell alerts, options alerts, trade ideas, and a lot of other private videos, lectures, tutorials, all that stuff is going to be included. So link's going to be down below. So the deal was, quote, one of great breadth for the stability of international finance. And going over to some of the specifics, the deal follows the collapse of two large U.S. banks last week that spurred a frantic and a broad response from the U.S. government, preventing any further panic. And that's why the Federal Reserve has also opened up their U.S. dollar swap lines to other central banks over in Europe and Asia. And as part of the deal, approximately 16 billion francs or $17 billion worth of Credit Suisse bonds will completely be written down to zero. They will be wiped out. These are called the AT1 tier bonds, and the bondholders in this case are not going to receive any funds or any principal back on the bonds. And the overall acquisition is going to be about $3.3 billion, as we've already talked about. And the entire combined deal is going to put the assets under management for these two banks at over $5 trillion. Which is 6 times the Switzerland's GDP, which is about 6.25 times Swiss GDP of about $800 billion. So that's the size and scale of this deal. And we also want to address here that 3 months after Lehman Brothers collapsed in September of 07-08, such swap lines, this is the US dollar swap lines, which the Federal Reserve has agreed to lend out on a more daily basis up until at the end of April, they were tapped for $580 billion. And of course, we also added swap lines rolled out during market turmoil and early stages of COVID-19 and during the pandemic of March 2020. Now, I do want to play a very small clip that I was able to find. This is like an hour and 37-minute long sort of presentation or press conference between regulators over in Switzerland and the UBS chairman as well. So we'll kind of listen to that and we'll go over some of the thoughts and opinions, and I'll share my thoughts here. All right, so let me just go over and share this.
John O'Donnell from Reuters. One of the big lessons from the financial crisis was that there would be no more public bailouts of banks, and also that banks that were too big to fail wouldn't be created. And yet the decision today creates a bank which is even bigger than any bank which has ever existed before in Switzerland. And also the vast majority of the cost of this bailout is borne by the state and the Swiss taxpayer. Could you comment maybe on that, and also perhaps about the division of cost between private investors and the Swiss taxpayer?
Well, I don't know if the question goes to me. I have to state that very clearly. This is no bailout. This is a commercial solution because we have a takeover of UBS. UBS is taking over Credit Suisse. So this is a commercial solution and not a bailout. We really wanted to avoid a bailout for different reasons. But I just maybe come back to the question of the too big to fail framework. I mean, the too big to fail framework couldn't have been applied here really, because usually, this is applied to a bank that cannot meet its liabilities anymore. And here we had a problem of liquidity. So it is not typical at all, And as I stated in my introduction, also the bankruptcy of Credit Suisse would have had a collateral damage, a huge collateral damage on the Swiss financial market, also risk of contagion for UBS and other banks, and also internationally. So I was in contact with my colleagues from UK and USA. They're very grateful for this solution because they really feared that there could be a bankruptcy of Credit Suisse with all the losses. And
So there you go, right? So according to Swiss finance minister, this is not a bailout, which I do disagree with because they have a contingency in there where they are going to absorb Credit Suisse losses of up to $9 billion, and they're also going to provide liquidity, additional liquidity of close to 100 billion US dollars as well. So there's a lot of sort of different terms and different, things in there in that agreement that definitely do provide not technically a bailout, but definitely a merger in a sense that it definitely does benefit UBS and also, protects UBS in a sense that, okay, they're not going to absorb all the losses. Instead, the Swiss national government, the Swiss finance department is going to absorb that as well and provide the liquidity, additional liquidity that they need. This right here was the other thing that I was talking about, the $17 billion risky bonds now worthless after the takeover by UBS. And those bonds were created for moments like this, but this will trigger a complete write-down of the bank's additional Tier 1 bonds in order to increase core capital, and Swiss financial regulator FINMA said in a statement on this website. And meanwhile, the bank's shareholders are set to receive 3 billion francs because they are going to be acquired by UBS. So it's a very, very sort of a different sense, because in a capital structure, right, equity holders are the last ones to receive any capital. But in this case, equity holders are receiving, of course, albeit a huge discount, because the acquisition is going to go through at $3.2 billion, and the market cap for if you take a look at the market cap for Credit Suisse at the last count on Friday was a little bit under $8 billion. So yes, they're going to take a heavy bath here after the markets open on Monday, but the bondholders are going to get nothing, right? Absolutely zero. They're going to get wiped out, especially on the AT1 tier bonds. And furthermore, in typical write-down scenario, shareholders are the first to take a hit before AT1 bonds face losses. Credit Suisse also guided in a presentation to investors earlier this week. That's why the decision to write down the bank's riskiest debt rather than its shareholders provoked a furious response from some of the Credit Suisse AT1 bondholders. And it's pretty normal, right? I mean, if you're a bondholder in a company versus if you're a stockholder, who should get paid first in terms of that capital structure if the company were getting bought out or if it's going under? It's the bondholders, right? But it's the riskiest debt yielding a lot, and that's why the bondholders are not getting paid, equity holders, obviously, because of the merger. But this right here is going to be going over the GSIBs, so now one down and about 29 still left to go. So Credit Suisse was considered as a SIB, or systemically important bank. It's no longer part of the list anymore, or eventually won't be. It's going to get absorbed by UBS moving forward. And Genevieve also posted this, which I found very interesting. March 2008, Bear Stearns trades for $100 a day. Days later, it's bought for $2 a share. March 2023, Credit Suisse trades at $3 a share. And days later, or says later, it's bought for 54 cents per share. Definitely at a huge discount than where it's trading at the moment. History doesn't repeat itself, but it does rhyme. And this right here is the paper that I wanted to break down very, very quickly. As you know, I've already included this in our Discord if anybody wants to read. It is 21 pages long, and it does go over a lot of things and specifically focuses on U.S. banks. And the abstract, as you can read, says we analyze U.S. banks' asset exposure to recent rise in interest rates with implications for financial stability. The U.S. banking system's market value of assets is $2 trillion, lower than the suggested by their book value of assets, accounting for loan portfolios held to maturity. So what that means is the banks collectively in the US, the assets that they have on their balance sheet. First of all, you have to understand the bank deposits for a bank are liabilities. What they invest in, mortgage-backed securities and US treasuries, are assets, right? So very simple. The banks, the way they make their money is by making the spread on the deposit interest they pay to the depositors and the interest they earn on their investments and their lending, right? So that's the spread they make. And for them, deposits obviously are going to be liabilities because they are short-term borrowings, right? They're paying interest to the borrowers, to the depositors, excuse me. And as an asset, they're investing in mortgage-backed securities, US treasuries, so they're earning the interest. So that spread obviously is the net interest margin, and that's how they make money. But the market value of these investments can drop if interest rates keep pushing higher, right? Just like, you buy a stock and stock price drops, the market value drops for that stock, right? The market value drops. And the same thing happens for these banks as well. But the problem is that they're never marked to market. They're mostly in their book value, their balance sheet. You always find the book value of assets that they currently own, but they're never marked to market. So this is exactly what we're analyzing in this paper, is that what is the actual market value of the assets they own? And that is $2 trillion lower than the actual book value. And you know what's even more interesting is that the marked to market bank assets have declined by an average 10% across all banks, with the bottom 5 percentile experiencing a decline of 20%. We illustrate that uninsured leverage is the key to understanding whether these losses would lead to some banks in the US becoming insolvent. Unlike insured depositors, uninsured depositors tend to lose a part of their deposits. The bank fails, obviously, and potentially giving them incentives to run. A case study of the recently failed Silicon Valley Bank is illustrative. 10% of banks have larger unrecognized losses than those of SVB. Nor was SVB the worst capitalized bank. Here's what's the crazy part. The SVB was not even the worst capitalized bank. The only reason it failed is because depositors panicked. Why? Because they were mostly tech companies and they were running through huge cash burns. They needed withdrawals. They needed cash because it was tech companies. And you know what's interesting? With 10% of banks having lower capitalization than SVB, on the other hand, SVB had a disproportionate share of uninsured funding. Only 1% of the banks had higher uninsured leverage, and combined losses of uninsured leverage provide incentives for SVB uninsured depositors to run. And of course, over 90% of deposits over at SVB were uninsured to begin with. When central banks, tighten monetary policy, can have significant negative impacts on the value of long-term assets. This is something that we have already talked about. It's a very, very simple process, right? So when interest rates do rise, prices fall. And this is a very good representation of how interest rates have obviously gone up in the last, year and a half. And as a result, this is going to be a quick ETF of residential mortgage-backed securities, residential mortgage-backed bond ETF. We've got iShares CMBS, that's your commercial mortgage-backed securities ETF, and S&P US Treasury bond ETF, right, or index, right? So these are all prices of these securities that have dropped as interest rates have really gone up. Now, the conclusion that they provided us with was that asset declines. However, after the recent decrease in value of bank assets, 2,315 banks accounting for $11 trillion of aggregate have negative capitalization. The conclusion was that we provide a simple analysis of U.S. banks' asset exposure to a recent rise in interest rates with implications for financial stability, and the U.S. banking system's market value of assets is $2 trillion lower than suggested by their book value of assets. In other words, there's a huge discrepancy between market value and book value by $2 trillion. And we show that those losses, combined with a large share of uninsured deposits at some, U.S. banks can impair their stability even if only half of uninsured depositors decide to withdraw. Almost 190 banks are at a potential risk of impairment to even insured depositors. 190 banks are at a potential risk to even insured deposits, with potentially $300 billion of insured deposits at risk if uninsured deposits withdrawals cause even small fire sale. Substantially more banks are at risk. Overall, these calculations suggest that recent declines in bank asset values significantly increase the fragility of the U.S. banking system to uninsured depositors running the bank. This right here is a very interesting table, which obviously goes over all banks, $2.2 trillion in aggregate losses. Small banks, $144 billion. The main concern here is large non-GSIB banks, because as I mentioned before, if you are an SIB, somebody's coming to save you. Treasury Department, FDIC, Swiss national government, we've got the Federal Reserve. If you're a systemically important bank, you are going to have somebody to come in and save you. That's however hypocrite that is, it is true, right? I mean, with banks, it's like if you are one of these big banks, you can take all the risk with literally no downside, because if you profit from the risk that you take, you get to keep all the profits. But if you lose on your risk or the bet that you're making, you are going to get backstopped. There is going to be some treasury or government pretty much stepping in to save you. So you've got all the upside with no downside if you're an SIB, right? That's pretty crazy to think about in the first place. But what I want to address here in this video is this large non-systemically important banks that have $1.3 trillion in aggregate losses on a market value basis. That's what's concerning to me. If those are the larger banks, they could still create a contagion effect and not be able to pay their insured depositors because they're so underwater on their securities. on their treasuries and mortgage-backed securities. This right here, the figure plots 10 largest insolvent banks. And you know what I didn't like about this report is that they didn't really mention which banks they're talking about. So again, I'll be doing more research on this. Don't you worry. I will be going over in detail which banks are the most sort of underwater and the ones that are more susceptible to having those losses. But these are the 10 largest insolvent banks. A bank is considered insolvent if the mark-to-market value of its assets after paying all insured deposits is insufficient to repay all insured deposits, right? So mark-to-market value of assets is insufficient to pay all insured deposits. That's when it's considered insolvent. And on the y-axis, we've got plot mark-to-market losses as a percentage of initial bank asset value. And on the x-axis, we plot uninsured deposits as a percentage of mark-to-market bank's asset value. And of the 10 largest insolvent banks, one has assets above $1 trillion, 3 have assets above 200 billion, 3 have assets above 100 billion, but less than 200 billion, and the remaining 3 have assets greater than 50 billion. So these are all pretty sizable banks, and the assets are based on bank call reports, and banks in the top right corner where Silicon Valley Bank is have the most severe asset losses and the largest runnable uninsured deposits mark-to-market assets. Silicon Valley's over here, whatever this bank is, E and G, and pretty much all on these lists, but the more you are towards the top right, the worse the situation is for those particular banks. So just wanted to go over this. This is definitely something crazy. Let me know your thoughts in the comment section down below. What do you think about this research paper? And I'm not going to let this go. I'll definitely be doing more research on these companies, because the last thing I want is for these banks to start falling over like dominoes and for us to not be prepared. So I want you to be prepared with your deposits and kind of, you know, go over, analyze your bank, how well they're doing. And I'll go over a separate video going over how to actually do that. But what's going on, man? Let me know in the comment section down below. What do you think about this? As always, happy investing. I'll see you all in the next video.